This short video I wanted to do last, and just wanted to cover two things. One is the demonstration problems of rental properties, personal use rental properties, and then the other one is hobby losses. While I encourage you to study in the text some of the details of hobby losses, really there's a couple of points I think that should be emphasized here. One is that hobby losses cannot offset other income. So if the expenses in a hobby activity exceed the revenue it generates, such as a fishing charter or sewing or writing software, then those expenses can only offset the income. They may not offset other income, such as wages and salaries on 1040. If, however, the activity is qualified as a for-profit seeking activity, then like any business, the net operating loss can offset other income. So I just wanted to emphasize that point. It's really an important issue regarding whether or not hobbies are accounted for as business or as a business or as a hobby. And there are rules regarding showing income in 3 of the last 5 years and the order in which expenses must be taken that will, if you study in the text, will round out this conversation regarding hobby losses. I also wanted to go through a couple of examples of how to allocate income and expenses as it relates to a second home that is used both for personal use and for rental use. So in this case, Jermaine owns a rental home in Lake Tahoe, traveled there from his home in San Francisco for maintenance and repair 6 times a year. The home round trip from San Francisco to Lake Tahoe is approximately 167 miles. How much travel costs can Jermaine deduct for the current year related to the rental home in Lake Tahoe? So I have the data entered as the 6 trips, and I also have the number of miles traveled, and then I just add and multiply the two together to get the total miles. Reimbursement mileage rate of 54.5 cents. So the deduction for deductible travel costs will be the 54.5 cents times the number of miles driven. In the second case, Matt and Marie own a vacation home at the beach during the year. They rented the home for 42 days, 6 weeks at $8.90 per week, and used it for personal use for 58 days. I encourage you to study the rules regarding the 14-15 day rule and how to determine whether or not we consider these expenses to be personal, rental, or a combination of the two. But I do have listed here some of the expenses that relate to the property. And so I even have the rental income listed here, rental income per week. Now a couple of things is, where do these expenses get recorded, and which expenses are recognized for what purpose? Well, in this case, if you look back at the number of days that are used for personal use and for the rental property, this is clearly a dual purpose property. That is, it's used for personal use, which would be recorded on Schedule A, and also for rental purposes, which is recorded on Schedule E. So over to Schedule E, we can take the mortgage interest, and that means we have to allocate between the rental days and divide that into 365 times the total, bring it up here, total value of the mortgage interest. So the 4,100 times the number of rental days divided by the total number of days in a year of 365 is the way to allocate this mortgage interest to the rental property on Schedule E. The balance would be recorded on Schedule A as an itemized deduction, the 3628. Property tax is a very similar way to apportion the property taxes for this dual purpose property, rental and personal use. And so very similarly, we take the, scroll up here, we'll take the rental days of 42 divided by 365, and this time we'll allocate it, multiply by the $750 of property taxes. And that is the amount, the $86 then, that we would recognize on Schedule E as a for AGI adjustment, and the balance of property taxes would be deducted as an itemized deduction on Schedule A. All the rest of these expenses then relate to, so if we scroll down here, insurance, certainly they relate to the business, the rental property, but only a portion of these insurance costs are going to be deductible on Schedule E as a rental income expense. In this case, we're not going to apportion it by the number of calendar days in a year. Rather, we're going to apportion the insurance expense, which is listed here at $1,200, times the ratio of the rental days to the total number of days, that is the 42 plus the 58. So in this case, it's not going to be 42 into 365. It'll be 42 into the total of 42 plus 58. And then we'll multiply that by the insurance cost of $1,200, and we'll have Schedule E insurance deduction of $504. It's interesting to note that the mortgage interest and the property taxes are allocated according to calendar days. However, the other expenses are allocated in the same way, and that is the same way I did insurance, and that is not based on 365 days per year, but based on the ratio of 42 divided by the total of 42 and 58, which is 100 days. So 42% of these expenses then are allocated to the business. The rest, however, are not deductible on Schedule A. These are not itemized deductions. Personal use property, we can't depreciate, repairs, utilities, insurance. These are, as itemized deductions, not deductible. But to the extent that they are applicable to the rental property, we can deduct them on Schedule E. So I wanted to make that really important, I think, distinction when we're allocating dual use second home or properties between rental purposes and personal use. If you have any questions on these or other concepts raised in either of the two videos, please let me know.